Weber, president of Weber Asset Management. Today is July 24th, 2023. I'm here in New York. Out in Lake Tahoe is my friend and business partner, Jack Bowers. And as usual, we're going to talk about the overview of the economic scene, both here and abroad. So, Jack, the question on everybody's mind, we might as well start with inflation. Inflation was rampant 6 months, 12 months ago. And the current inflation rate is something like 3% here in America, slightly better than most of the other developed countries. So knock on wood, that's a good thing. 3% is still slightly above the target of 2%. But man, we've come a long way from the 8 or 9% inflation. So what's your opinion about all that and where we are and where we're going with inflation?
Yes, things looked pretty ugly a year ago, but boy, what a sea change. We're down kind of in that, I would guess, 3 to 4% zone, and we're probably going to stay there for the rest of the year. I think a lot of people are coming into the labor force. It's kind of taken the pressure off of what we were seeing before. We're not in as bad a shape as Europe and some other countries. Of course, we don't have potential deflation like China might be seeing. But all in all, it's consumers are still spending, and enjoying the wage gains. And I think the rents have peaked, and we're starting to see rents come down a little bit. And it all, I think, bodes well for a relatively fast return to, the 2 to 3% range. We may not see that this year, but I think certainly next year, if you look at the 5-year break even, the bond market thinks, the next 5 years is going to be inflation in the 2.1 to 2.2% range. So really, I know there's discussion about whether the Fed is going to be done this month or not. I'm kind of the opinion that the one and done is our most likely scenario here.
Two thoughts. One is that there's always something to complain about.
That's for
politics
sure.
And in economics, there's always something. And one of the current things that somebody just brought up to us, what about the housing market? You can't rent and you can't buy, and it's a mess. I said, listen, so much is good. You will never, our clients and everybody else has to understand, there has never been a time when everything is good. There's always something that's weak or dangerous or questionable. So let's just, what do you think about the housing market in general? Because that can be, pardon me for interrupting, housing market can pull down as it has in the past. Much of the economy if it really continues as a problem.
Yes, I think it's starting to cool off. It just hasn't felt that way because there's been so little inventory. Everyone who, locked in mortgages back when they were cheap doesn't really want to move now. And so there's just no inventory at all. But, the population is aging. A lot of people are downsizing and moving out of their higher tax states so that they can be in a lower cost retirement area. And so you just do have a lot of local markets where things are tight. I think a lot of the home builders who kind of buckled down thinking it was going to be a long, hard recession are now going back to building a lot because they're the only source of new supply since existing home inventory is so low. And they're now accounting, they're normally new home constructions, maybe 10% of the market. Right now, it's above 60% in some places.
Go ahead.
Yeah, I think it's, slowly cooling off at this point, and I think we'll continue to see it cool off. And even though the inflation comes back to normal, it may be that mortgage rates take longer because the Fed is going to kind of make sure that the victory we have over inflation is a permanent, not a temporary one. So it may mean that a lot of people looking for houses will continue to struggle with a lack of inventory and high cost financing, but it may be the price that has to be paid to kind of get inflation under control and back to the Fed's 2% target.
When you talk about the housing, the builders sort of miscalculated, but based on a longer slow market. The same thing with the airline industry, where they laid off lots of workers, thinking that COVID is going to ruin travel for a longer period than it actually did. And now they're all scrambling to hire people. Pilots, there's a big shortage, and just general staff. The FAA is scrambling to put people in the control towers.
Yes.
So, there's no science to this. It's all an art and science in every industry, including what we do.
Yes.
Everybody is taking their best guess. You can get the best and brightest and they still screw up. So
Yes. Yep.
you just look at the big picture. The big picture right now, don't want to jinx anything, but right now, things are looking good. I'll just say in terms of the Fed, this morning, I happened to hear one of the Fed governors said he expects 2 minimum rate hikes. I guess that means 0.25% each time. So he's expecting 2. You think 1. I'm agreeing with you, by the way.
Oh, okay. Yeah, it's possible they know something that we don't know that hasn't been released. And it may be they're troubled by the strong employment market. But in my mind, in the past, a strong employment market might have been kind of an inflationary signal. But I think given where we've been and where we're going, I think a strong employment means people are coming back into the workforce. There's more labor competition. Employers are finally getting, back to having full staffing like they had before. I think it may put some upward pressure on inflation, but it may also be easing it at the same time, just because you have enough people to do things again, and you don't have to pay outrageous, benefits and bonuses to get people to come to work. So
right. And I don't want to leave the topic of inflation without pointing out, Jack, I think you made a prediction about a year ago about inflation.
Yeah,
it was much higher.
Remember late last year, early this year. Yeah. That we'd be under 4% before the end of the year. So,
and I'm sure a lot of our listeners were skeptical.
Possibly. Yeah. And it isn't really, you can't really put that victory in the bag yet, because we don't know what the inflation is going to do between now and then. But I think with declining rents, it's a pretty safe bet we'll be in that 3 to 4% range for the rest of the year. So yeah, we'll see.
I hope so. And I think, it's still above the 2% target, but I think the economy can live with that for a while without going into recession.
Yeah, especially when you look at blue collar wages being up as much as they are. Most people have not had trouble. Some people have had trouble keeping up with inflation on an after-tax basis, but in a lot of employment markets, the wage gains exceed inflation in the last few years, just because employers had to, raise their prices to attract people back into the workforce. Right.
And there are many people who are not keeping up with inflation, but hopefully they will. Things will start to improve for them as well.
Yes.
I want to move on to the stock market. We've been in a bull market as of today. We're up roughly. I hate to say these words because I was superstitious and jinx it. S&P is up close to 20%. Our select system is up more than that. So it's a good year. So I want to talk about what your expectation is, and then we'll talk about the narrow breadth of the market. So let's just get right to your forecast for the next 3 to 6 months.
Okay. I think we've seen a lot of technology and technology disruptor run up on, the assumption that the Fed is nearly done and that growth in those groups will continue. AI, artificial intelligence, has been a factor as well. I think there's perhaps a little too much enthusiasm over that, but it is also running up a lot of the technology disruptors that already have been benefiting and adding to some degree to how pricey they are. In the past, it's been kind of a negative indicator when you have a handful of stocks dominating all the stock market gains, and we've seen
it's basically 7 stocks, high tech stocks. The big names that are accounting for more than half the movement of the S&P 500.
Yes.
Should we worry about that?
Yeah, in the past, narrow breadth like this has been kind of a warning flag. But I think when you look at the fact that this is at least partly driven by robust technology sales and AI opportunities, these are things that have potential productivity benefits for all corporations, not just tech. So I think there is the potential for the rally to broaden into a lot of the other companies that may benefit from this technology. And once, you know, people feel better about the fact that the Fed is probably really done, we should see a lot of kind of mid-sized and smaller companies kind of enjoying a little bit more of the benefits in terms of earnings forecasts and economic recovery. So, you know, we can never know for sure, but I'm kind of on the optimistic camp that we'll see this kind of breadth spread out, and that other stocks will join the whole rally as the economy and the options for the economy tend to improve. I think a lot of the forecasters are, you know, perhaps placing too much credence in the inverted yield curve, and they're, you know, still keeping their forecasts relatively pessimistic on the economic side. And once the Fed's done, I think people can start to look at, you know, what's going to happen, and maybe the yield curve doesn't matter as much, and maybe the consumers continue to carry the economy along, and we you know, end up with a soft landing. I think that's looking like more than a 50% chance at this point.
I agree about the soft landing. I'm a little concerned about the market short term. I think it might have gotten ahead of itself to be up this much this quickly. But I think hopefully by the end of the year, we'll be steady with some nice gains.
Yes, we're trying to move a little bit of the portfolio into kind of some of the beaten down sectors, and not add to the higher pricier tech side. You know, we made a recent move into the Russell 2000, kind of a direct index bet in many portfolios. And we've boosted our stakes in equity income, which is kind of cyclicals and financial stocks that might be looking a little better for the balance of the year than they did the first half. So no major moves, but just kind of things that might emphasize the cheaper side of the market a little bit, and in anticipation that group might be performing better going forward.
And we can't leave without talking a bit about bonds. You mentioned the yield curve, which is a little bit wacky lately, but if the Fed is going to boost interest rates 1 or 2 times, what does that mean for bonds? How are we positioning our clients in terms of those who hold some bond positions?
Yes, right now, for kind of the more aggressive side of the conservative accounts, we've got a high.
That's an oxymoron.
Yeah. It's just kind of, we have 2 levels of risk with our accounts. One that targets close to a 0.6 relative to the S&P 500 for volatility, and then another group that targets 0.8. So for the how shall I say it, less conservative accounts,
Right.
The 0.8s, we have, you know, an index bet, and then also a high yield bond, a short-term high yield bond position, and on the assumption that the economy will hold up better than expected. And we haven't really changed that at this point. There's a potential to move to something that has a little more corporate debt, which we might do later on. But right now, I think we're not likely to see big moves for the bond market in any direction, up or down. I think this is going to be kind of a slow, long, drawn out recovery for the bond market as the Fed kind of comes back to normal, you know, once they have confidence that inflation is going to return to 2%. But that may be something that plays out over 2 or 3 years.
I'll be really curious once the Fed signals that, okay, we're done, how the markets, bond and stock markets, are going to react at that point, both domestic and international. Because, you know, the cliche is, well, this time it's different, but every time is different.
Yes,
we never have exactly
true.
the same scenario. So it'll be interesting to see once Jay Powell and or the rest of the Fed say, okay, you know, we're not going to raise rates anymore. What will happen? The market might get ahead of itself in anticipation of that. Then there might be a sell-off on the news. It'll be interesting to see, but hopefully we have our clients positioned either way.
Yes. Yeah. I think the Fed is kind of once they are done, they're still probably going to keep rates high for a while. So that kind of says that the short-term bonds are, probably stable because the interest rates there on the short end of the curve are going to be stable.
Right.
The long end of the curve, that's more kind of set by global forces. And right now, I think we're heading into a period where the U.S. economy is going to be stronger than many other major economies in the world. And so that would tend to put downward pressure on the long dated bonds. So we may see this inversion stick around for a little longer than we'd like, but I don't think we need to assume that because the bond market stays inverted that it's going to stall the U.S. recovery. I think to some degree this type of inversion doesn't matter that much.
When you just mentioned the U.S. economy is strong, Morgan Stanley this morning said the GDP is much stronger than expected. GDP growth.
Yeah, we've seen a steady stream of upward revisions with GDP. It's largely due to exports and consumer spending, and it may probably continue. I think this is not a short-term trend.
Let's hope. Let's hope. All right. Well, everybody, stay cool. If you're in the heat dome, there are several heat domes around America these days. Out not far from Jack, in Nevada and all those places. I just feel sorry for you clients who do need to go out into 100, 110 degree temperatures. We have clients throughout the Southwest, certainly. So do your best to stay hydrated and out of the direct sun. Anyway, Jack, good talking to you. And
yes.
See you next time. Bye-bye.
Likewise.
Thank you.
Bye-bye.